This podcast is sponsored by Daloopa. Earnings season is hectic. There's no way around it. But what if you could take back the time you spend on manual model updates? With Daloopa, you can. Automates your audit and update process, instantly pulling accurate, fundamental data from filings and reports directly into your models. That means no more wasting hours on repetitive tasks. Instead, you can focus on analyzing trends, refining strategies, and staying ahead of the competition. Stop letting manual work slow you down. Set up a free account today by visiting daloopa.com/YAV and see how Daloopa can transform your workflow. That's Daloopa, DALOOPA.com/YAV. All right, hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it means a lot if you could rate, subscribe, review wherever you're watching or listening to it. I've got a smile on my face because having on today my friend Yaron Naymark from One Main Capital. And as I told him the last time I saw him in person, you got to wear the shirt the next time you come on. And he is a member of the Five Timers Club. If you're watching on YouTube, he's got the Yet Another Value podcast shirt on. Yaron, how's it going?
Good. How you doing?
Doing good, man. Excited to have you. Before we get started, quick disclaimer, remind everyone, nothing on this podcast is investing advice. That's always true, maybe slightly more true today because Yaron and I are going to be heading back over the pond and talking about an international stock, doing an update. So people should remember, nothing on this podcast is investing advice, consult a financial advisor, international stocks carry extra risk, tax uncertainty, all that sort of stuff. So I think disclaimer out the way, Yaron, it's been an interesting year for IWG. We've done a podcast last year on IWG. I think we were chatting and we thought an update pod might be interesting. So I'll turn it over to you. Maybe you can quickly give a refresher on who IWG is, what the IWG story is, and then we can kind of start diving into what happened to them in 24 and what we're thinking about going forward.
Yeah, so IWG is the largest co-working flex office company in the world. It's been around longer than WeWork, longer than Industrious. It's significantly larger than them. If this is the first time you're hearing about IWG, you probably have heard of WeWork and maybe not of IWG's brands, which consists of Regis, Spaces, HQ, Signature, and the likes. But anyway,
you forgot about one. I'm coming to you from the Commons office right now. I'm long IWG from the leasing perspective.
Yeah. There's actually a longer tail, but those are the big ones. Co-working has become a larger part and more relevant part of the office market over the last, 10, 20 years, significantly so over the last 2, 3, 4 years. If you look back a decade ago, it might have made up less than 1% of total office space. Today, it's low single digit % of the office space. That number continues to increase. IWG has, grown to 4,000 locations globally, primarily through reinvesting its cash flow, which has been positive. So it's been a profitable company, reinvesting its cash flow into new locations. And it's recently embarked on a capital light strategy where it has a managed and franchised model where it goes to building owners and tells them that they can, the IWG can create a co-working space in their building for an upfront fee paid to IWG, and then an ongoing management fee, which comes out to about 15% of revenues. The landlords put up the capex themselves. They pay IWG a 15% management fee, and IWG runs it for them as part of its 4,000 and growing network of co-working spaces. The stock is incredibly cheap today, but that includes very limited contribution from this managed business. I think the managed business is starting to inflect and is going to create substantial value for IWG shareholders going forward. To give you a sense, today, IWG generates almost zero EBITDA cash flow from this managed business. It still trades at 7 times my 2025 free cash flow number. So it's about a $2 billion market cap today. I think they'll do about 300 million, probably slightly under, but about 300 million of free cash flow this year. And so 7 times my free cash flow number this year, very cheap on its own. The core business is growing and should continue to grow, but the management fee business is about to go from zero of EBITDA and free cash flow to hundreds of millions of EBITDA and free cash flow. And that is an EBITDA and free cash flow stream that comes with zero capital intensity, high margins, highly recurring revenue. And I think will be worth a very high multiple of those earnings as they come. And so I think there's a lot of growth in earnings and free cash flow here. It's from a very low starting valuation. I think that's a recipe for really strong stock performance. And there's a lot of other interesting stuff that I think make the stock more timely. I think, we've spoken about IWG in the past. And someone might ask, why now? Like, why were you wrong before? And there's a lot of reasons. We could talk through all of them. But just to summarize, I think, 2.5 years ago when I first got involved with the stock, they started signing these management agreements, and the management agreements take time to design, build out, open, fill, and convert into management fees. I was really excited about the KPIs. In the first year, they made a big push towards these management agreements. They signed 400 of these locations. Again, back then, their global base of locations was maybe 3,000. A year later, they signed about 800. This past year, they probably signed close to 1,000, maybe slightly under, but about 1,000. And those KPIs got me really excited, but they never really converted into system sales, EBITDA, and free cash flow. And I think that lag is finally starting to hit the income statement in 2025 and 2026. It's going to accelerate even further. And so as we sit here today, the core business profitability has improved substantially from 2 years ago. Coming out of COVID, occupancy is still back up in their core locations. And so EBITDA has almost doubled, up probably 70%. If you're not looking at it with deducting partner contributions, and up almost 100% over that 2-year period if you are deducting partner contributions from EBITDA. So profitability is up a lot. They've generated a few $100 million of free cash flow. They've paid down debt with it, and the stock's basically gone nowhere. So flat stock price, lower net debt, significantly higher EBITDA, and we're 2 years closer to these management fees starting to contribute substantially to earnings and free cash flow. On top of that, some of the problems that have led to the stock being depressed, I think, are in the process of getting rectified. One of those is the stock is listed in the UK today. It's a very small percentage of their business actually comes from the UK. Most of their business is in the US, and this really does belong on the US stock exchange, whether it's the New York Stock Exchange or NASDAQ. And the company has been working on doing what it needs to do to eventually get a US listing. The biggest steps have been converting from IFRS accounting to GAAP accounting, converting from sterling reporting to US dollar reporting. So 2024 was the first year the company reported in US dollars. 2025 will be the first year the company reports in US dollar GAAP instead of IFRS. GAAP accounting makes it significantly easier to understand the accounting of this business because of the lease structures of their own locations. And so from just an ease of understanding the financial reporting, it's getting easier. It's getting easier to relist this onto the US eventually. And the company has said that they want to start buying back stock once they get down to 1x net debt to EBITDA. Well, they're going to achieve that level this year in 2025. At that point, they're going to be able to start buying back stock, which I also think really helps, re-rate the shares. I don't think we don't need a re-rating to do really well here. I do think free cash flow is going to grow significantly over the next few years. I should keep reiterating that, but I do think, those things will help a potential re-rating. Another thing that's worth flagging is there was just a real validation towards co-working a couple weeks ago. CBRE, which is the largest, most sophisticated commercial real estate player, probably globally, bought Industrious. They already owned 40% of it, but they bought whatever they didn't own. So now they're going to own 100% of it. They paid an $800 million enterprise value for Industrious. Industrious has about 200 global locations. Again, we have 4,000. Industrious probably did $400 to $500 million of sales. We're $4 billion of system-wide sales. Industrious, barely generated any EBITDA on their $400 to $500 million of sales. That's my understanding. And we generate substantial EBITDA on our $4 billion of system-wide sales. So CBRE sees that co-working is going to be a part of every, end user of office space's real estate portfolio, and they want to have an offering for their clients. I think that provides strong validation that co-working is, is here to stay. It's a durable business. IWG is the largest by far in the space, the most profitable, the longest operating history. And so I think that validation is a big stamp of approval and kind of tells us that 7x free cash flow is way too cheap, especially if you compare that to the free cash flow or EBITDA multiple paid by CBRE for Industrious. So I might have other points that I think about as we continue talking, but I'll stop there and see.
No, I'm laughing because I don't know what other points you can have those up. But you touched on a lot of things that I did really want to ask you about. But let me start with, let's start by setting the stage just valuation wise. Roughly, as you and I are speaking, IWG is trading for 163. I don't know if it's pounds or sterlings. I can never remember what the listing is. But if I said, hey, Yaron, this is a $2.2 billion market cap company, $3 billion enterprise value company, would I be talking about correctly there?
It's about a $2 billion market cap and about 700. So I'm not sure if you're looking at pounds or US dollar, depend because they report in US dollar now.
Yeah, I think I switched over, and either way, we don't have to split hairs. But if you want to say
probably $700 million US dollars of debt and a $2-ish billion market cap. So
perfect. Just
high twos of enterprise value.
So I guess the first place I want to start is here. The company has said, hey, in the medium term, and you can correct me if I'm wrong, I don't think they've ever defined what the medium term is, but we're going to hit $1 billion of adjusted EBITDA. And we can pick apart that adjusted EBITDA in a second. But do you think that, look, if they're going to hit $1 billion in adjusted EBITDA, it doesn't matter if this is a coal mining company or, a tech growth AI startup, like $3 billion in EV is probably too cheap if they're going to do $1 billion adjusted EBITDA. Do you still think in the medium term that kind of $1 billion number is in play?
Yeah. So the medium term, I believe, is 2028. They didn't guide to that year specifically, but a lot of the charts in the Investor Day deck.
That's actually what I had in my head, but they never specifically said it. So I thought it was worth just telling. Yeah.
So the slides went out to 2028 on all the charts. So I'm assuming that's what medium term means. I think that the $1 billion is very much in play. I mean, there's some puts and takes. I think the two positives are in their core business, which is co-working, and the negative is in Worka, which is a business that they bought an asset called Instant. They merged part of their virtual office business into Instant, and that business has disappointed since the Investor Day. But the other two segments, which is the co-working spaces they manage for other parties and the co-working spaces they own and manage for themselves, have significantly outperformed, my expectations, and I think their internal expectations since they put that target out there. Worka, which has underperformed to a lesser extent than the outperformance in those two other segments. So I think the $1 billion is still very much in play. Hopefully they're able to beat the $1 billion, which I think they will. CapEx is a very small part of that EBITDA looking out to 2028. There's the taxes, very low interest expense because they're going to have almost no net debt, or they're going to have actually net cash by then. And so the $1 billion plus of EBITDA probably converts into 700 million or so of free cash flow. Yeah, and
as you said, 700 million free cash flow. The net debt's going to be very low at that point, even if they hold it steady at this level, like 2 billion ish, a little bit over market cap, 700 million free cash flow. Like, that's really interesting. Let me start with the biggest question. You mentioned
the most interesting part is that a significant part of that free cash flow at that point is coming from management fees, and I owned KKR from 2018 until the start of early 2024, and I always thought the management fees were undervalued by the market, and eventually the market realizes that a secularly growing, capital light, predictable, high margin revenue stream is worth a high multiple, and I see a lot of similarities between that management fee side of the business and the management fees at IWG. So I think it's worth, I think if the stocks, if over half of free cash flow at that point is coming from management fees, I think there's a shot you get a really big multiple on this stock. And, I think that's the upside case.
Then let me try and be a good host in response to that, because I do have questions on that as well. So I want to just ask, when you talk to people, franchisor, I guess the franchisees, when you talk to the buildings, the franchisees that are doing this, do you hear that they are happy with the IWG solution here?
Yes. So, I've spoken to dozens and dozens of building owners. I've started conducting surveys as well. And the most recent survey I did was like two, 3 months ago, got a little bit over 50 building owners. And, I asked a ton of questions, but one of the questions I always ask in every survey is, on a scale from 1 to 5, how happy are you with your current relationship with IWG? And it's been pretty consistent that 4 and 5, so meaning 4 and 5 is the happiest, 5 is the happiest you could be. 4 and 5 makes up a majority of those responses. 3s have made up single-digit percentage of the responses. And then there's been very few, if any, 1s and 2s across the survey.
Do you think there's a selection bias there? Like your broker is looking for people to talk about it, and the people who are unhappy with it aren't willing to pop on it?
No, I don't think so, because they do give negative feedback on what IWG could do better or what they're unhappy with. And by the way, those responses are consistent with conversations I've had with building owners myself, who've been very impressed with what IWG has been able to do. You know, I've spoken to building owners who gave IWG locations to manage that they currently had leased to a smaller co-working company, and the smaller co-working company was not able to make their rent payments because they were like, this location's bad, this, you know, co-working doesn't work in this building, and they've given it over to IWG to manage, and IWG fills it at higher rents per foot and operates it very well. So I've had anecdotal stories, you know, from conversations that I've had with building owners. Their surveys help as well. I think in general, you know, IWG is helping them convert empty space into monetized space at rates that are probably higher than they would get even if they were able to fill that space with a triple net lease.
What do you think the secret sauce is? Like, when I think about, obviously IWG knows a few people. I think I've gotten a little more skeptical on, I don't want to put words in your mouth, on the network effect of having like 100,000 units and me being able to be like, my home base is in New York, but when I travel to Boston, I can go to IWG. You can address any of that. But when IWG goes into a space and takes over from a small co-working and dramatically improves the operations. You know, if Chick-fil-A takes over a space that's run by Andrew and Yaron's fried chicken, Chick-fil-A is going to way increase the revenue, right? So what is the secret sauce that this big IWG brand does that increases revenue in the same way a Chick-fil-A would improve Andrew and Yaron's fried chicken revenue?
Yeah, look, it's a lot of small things that build on themselves to create a significant competitive advantage. I mean, customer acquisition is really important. You need to have a big funnel, and you need to convert those leads into signed contracts. So you need a big funnel, you need high conversion, you need to know how to price. You know,
what is their advantage in the funnel when a lot of their upcoming locations, I'm going to have questions on this, are going to be suburban, right? What is their advantage in the funnel in suburban? Because if you told me urban, I couldn't believe it. But when they move, if they've got no location in my hometown of Kenner, Louisiana, and they make a move there, like, it's not like they've got any, they don't have an existing sales space. They don't have an how are they going to get people there that Andrew and Yaron's local co-working were not, right? Because in my mind, suburban, if you want an office in a suburban, you just like look around for the nearest office space and kind of go there. So how do they improve the leads there?
Yeah, a lot of people just go on Google, you know, and you need to have a good customer acquisition.
You think I guess they're probably much better at SEO, right? Because
I think that's 100% right. So I think, you know, the brand, about 70% of their locations are the Regis brand, is very well known. But I do think the ability to marketing scale, right, and market sales and marketing budget, and then knowing which keywords to buy, and then and importantly how to convert those leads, right? That's really important. I don't know how many co-working spaces you've signed up for, but I'm on my second one, but I've shopped around a lot, and there are plenty of places that I've reached out to that they don't get back to me, or they get back to me a week late. IWG, if you put in your information, you will get a call within 5 minutes from someone, right? And they're trying to get you to sign a contract right then, and they're throwing promotions at you, and they just know how to convert these into signed contracts. And then once you're a signed contract, I think retaining you is also really important. So they know how to retain because they have years and years of operating history. They know how to price because in a lot of these locations, they have, you know, plenty of locations within 1 mile, 3 miles, 5 miles of where they're opening new ones. Or if not, they know other areas that have similar demographics, they have similar levels of occupancy, similar levels of co-working as a percentage of the total office space. And so they have a pretty good sense on how to maximize pricing. For ones that are getting built out for the first time as co-working, they know how much, you know, depending on the demographics and what type of space it is, they know how much common area, you know, open floor space to put where people are willing to share floor space with other colleagues, how much private office space to put, how much conference rooms to put, and how to price each of those things. And so I think it's important to fill the space, price it efficiently. They also have, you know, 15% of center level revenues normally come from ancillary products and services, not necessarily signed contracts. And so that's really important, being able to charge for a conference room by the hour, selling coffee, selling, you know, phone answering services. So the receptionist could answer the phone in the front. By the way, I'm in a Regis right now. They could answer your phone and be like, "This is One Main Capital. Oh, can I speak to Yaron? Okay, hold on. Let me check if he's available." They could collect your mail for you. If you're out of the office for a week, they could tell you what mail you got. These are all services that they charge you for. They don't do for free. And smaller operators don't necessarily know how to monetize each of those line items. And so
I'm
that's
laughing
really important.
because I was just going to forget smaller operators. I remember in 2016 when Mark Dixon was saying, hey, WeWork's getting 3% of their revenue from ancillary services. We've been doing this for 20 years. You cannot make a co-working space work unless you're getting 15, 20% of your revenue from ancillary services.
15 to 20% for them. And by the way, also they know how to keep costs low, right? They're one of the largest office furniture buyers globally. I think behind the US government, they might be number 2. They know how to staff, with minimal headcount. They know how to keep costs low in terms of the operating expenses of the location. They know how to build these spaces out cheaply. It's just a lot of things that compound on themselves to get to a place where they were earning, on their own locations where they were putting up the capital themselves. They were still earning after tax returns on capital in the 20s, right? And so WeWork was earning in the negatives, right? And a lot of the smaller players also aren't making money, or if they are making money, they're not making a lot of money. So I think all those things are really important.
This podcast is sponsored by Daloopa. Earnings season is hectic. There's no way around it. But what if you could take back the time you spend on manual model updates? With Daloopa, you can. Daloopa automates your audit and update process, instantly pulling accurate, fundamental data from filings and reports directly into your models. That means no more wasting hours on repetitive tasks. Instead, you can focus on analyzing trends, refining strategies, and staying ahead of the competition. Stop letting manual work slow you down. Set up a free account today by visiting daloopa.com/YAV and see how Daloopa can transform your workflow. That's Daloopa, DALOOPA.com/YAV.
Let me ask you slightly different. There was a commentary on the Q3 call where they said, hey, the main obstacle right now to us, I believe it was to signing up franchisees and managed spaces, is ability to fund. And that was kind of surprising to me because in my head, most of these franchising leases, not all of them, but it's not like it's ability to fund a new building. These buildings are already built. In my head, the space is generally out. And if they switch over to Regis, they're basically saying, hey, this space isn't working for XYZ reason. And yes, Regis probably needs to come in and slightly shift the floor plan, put in some furniture and everything, but that's not a huge haul versus the cost of a building. So I was a little surprised by them saying funding is an obstacle. And this doesn't change one thing or the other, but whenever I see something that surprises me, I like to check because sometimes it indicates there's a really big misunderstanding on your part. So just wanted to ask you about that piece.
Yes. So anytime you're going to even sign a 10-year lease with a new tenant, you're giving TI allowances. So you need to come up with cash to help the build out of that location for your new 10-year tenant. In general, that's a much smaller amount than when you're converting it to a co-working space yourself. The numbers I've gotten, from talking to building owners and from some of these surveys are that, if you're trying to convert something that was previously a co-working space, or maybe a law firm that had a lot of small kind of cubicle offices, maybe the costs are $20, $30 a foot. You can get up to $100 or $150 a foot for the really nice locations that you want to convert. And so, the average location size, I think, is 12,000 square feet that they're signing. There's some that are 10,000. There's some that are 18,000. So if you put $50 or $100 a foot on, call it 15,000 square feet, that's a lot of CapEx the building owner needs to put in. Now, generally, they should be earning a good return on that CapEx, right? They're going to get their market rent plus a spread. And the way to think about that spread is IWG typically, right, on their own locations is earning center level EBITDA margins of 30% after rent, right? And here rent goes to zero. And so that 30% is the spread they were earning after paying rent. The landlord doesn't have rent. And so that uplift goes up significantly when you're not paying rent. You still have to take off the 15% management fee, but that's kind of how to think about the return that they're getting on CapEx. And so they get their market rent plus a return on the CapEx they're putting in. But you need cash and you need confidence to do that. And not only confidence from the equity holders, but also confidence from the lenders who need to sign off on these types of leases. And so, in an environment where building owners are thinking of giving back the keys to the banks or going to the bank, maybe they're distressed, they're looking for an extension on the loan, they're going to the bank saying, how would you think about this? The banks typically like 10-year leases, guaranteed rent. Landlords obviously like that as well. And they need to get comfortable and have some kind of confidence to make an investment of that magnitude into their locations. Now, the confidence comes from, one, the broader economy, which, with interest rates going up and office not doing that well, that's been tough. But then also from word of mouth and seeing their peers doing it and seeing IWG saying, look, we've done this 500 times before for other buildings that we've managed 1,000 times before, and look at the results. And so I think as you have more and more of these popping up managed locations, not only in the IWG network, but also within Industrious and within the smaller players, there's Serendipity Labs, there's a variety of other ones that are going the management agreement route as well. And I think in general, banks are getting more comfortable with it. Landlords are getting more comfortable with it. And so when I speak to small operators, they're saying it's getting easier and easier to convince landlords to go in this direction. 5 years ago, you would pitch this to a landlord and they would look at you like you're taking crazy pills. And now everyone kind of gets it. And so that I think hurdle is getting easier to overcome. The interest rate and economy hurdle is still, that's where they've gotten held up with a lot of their signings that they signed 1 or 2 years ago that are taking a little bit longer to build out, as the building owners are like, okay, I get the model, I'm on board, but do I really want to put $1 million of CapEx into this location right now with the economy and interest rates doing what they're doing? And so it's been slower to open new locations than we would like, but they're still opening.
That was a fantastic answer. Do you think WeWork, I've looked at a lot of QSR franchisors recently. Do you think IWG would be well suited to say, hey, you're having trouble financing, right? We'll do the conversion and we'll lend you the money, we'll lend you half the money, which a lot of these guys do. And in return, we'll just take it off the top on the franchise fees for the next few months until we get paid at a pretty healthy interest rate. Do you think that would make sense, or would you not like to see them go that direction?
I've actually spoken to people to try to figure out if there's a way to get, a credit facility. I'm not sure I'd want IWG to do it off their balance sheet, but if you could find a third party who's willing to finance it, the duration on these would be very short. The payback would be pretty quick. But because the pool of management agreements is growing, you could actually get some pretty big outstanding balances and keep rolling them as you're growing the network. And if there was a way to have a third party put up the capital, but we would basically pledge our management fee to that third party to reduce the risk for that third party. Even the management fee on our blended management business, not necessarily on that one location. That's something that I think could be really interesting. I'm not sure how likely they are to do something like that, but I think that'd be great.
Just the thought I had. Yeah. Let me ask one more thought, and I hate to get too deep in the weeds, but Q3, RevPAR on the management agreements is $412 in the quarter. They say, hey, once everything fully run rates, it's going to be $315 on things that are already opened. And in the long run, we think it's going to be $250, right? And now what's happening is you're going from, my Midtown New York City shared office space to I use Kenner, a Kenner shared office space, right? The RevPAR is going way down because you're opening more suburban locations, which command much lower rents. And I guess my question is, as all of these new signings happen and they go much more suburban, I have two questions. A, can they still kind of hit their numbers and their growth rate? As it's going to take, if you kind of work that math out, it's going to take 3 suburban locations to match 1 New York City location in my example. And B, is the moat in suburban, we talked about on the cost side, but I would like to discuss a little bit more, like, is the moat that unique in suburban locations? Because if I'm in the suburbs, I'm probably driving, I've probably got a home office, maybe, I don't know. I'm more thinking from a sole entrepreneur space, but it does seem like it's not as strong as in an urban location. So I threw a lot out there. I just turned that over to you.
Yeah, so RevPAR has been coming down for a couple of years now on the managed side. Part of that is it's more suburban locations. The other part is you're just opening new kind of emptier locations, right? You're opening them at 30%. You're opening them at 30% occupancy, and then they scale. They eventually scale. But if you're opening a lot of new ones, that drags down your RevPAR.
They've got the slide in their deck for that. Though I do think they say, hey, here's the RevPAR once all of these are fully scaled, which should adjust for some of that, right?
Yeah, yes. I think once you get down to the RevPAR they're talking about, which I think the RevPAR they're talking about still takes into account that a bunch of the locations are not full yet because they're new. If you normalize to maturity, the RevPAR they're talking about, I think it would end up being higher. once you get to that point, RevPAR should start growing and getting closer to the system, right? As you fill these newer locations. But RevPAR has been coming down because you're opening in the burbs and you're opening newer locations. I think the important thing to note is that I think most of the decline in RevPAR is through the system. RevPAR should still decline a little bit in 2025 because you have a ton of new locations opening. But I think from 2026 and beyond, it should start to grow. Maybe 26 is flattish, but I think it should start to grow in 26, maybe 27. And from that point, it should be slightly below the corporate locations because corporate have a bigger city mix, but not that much below. I think it's good that you brought that up. That's one of the reasons why I think the stock hasn't really worked over the last few years. There's a bunch of reasons, we can talk through them, but that's one of the reasons is that, initially when I was looking at these KPIs, I'll just to say it bluntly, my out year numbers, my 2028, 29, 2030 numbers have come down substantially from when I bought the stock. Right. When I first was buying the stock, this was a brand new concept, this management agreement thing. The KPIs were really good, signings. And all we were able to do is look at signings and what they said the unit economics are, which are an upfront license fee, 15% of sales. And we had to assume what an average location looked like in terms of revenue, occupancy, price per foot.
Yep.
And so initially, I probably thought the management fee per location was going to be $1 million of average center level revenue times 15% would be $150,000 of management fee per location. It turns out it's going to be substantially below that because, your traditional center was about 20,000 square feet. The new managed centers are in the burbs and they're probably closer to 12,000, 13,000 square feet. And then the rent per square foot in the traditional center includes city and outside of city. And most of the managed locations are outside of city. And so you're probably looking at like 40-ish% lower revenue per managed location. And then on top of that, because of what we spoke about just earlier, it's taking longer to kind of build these locations out and fill them. And so signings have been really good, probably better than I thought. But openings and then the conversion of those openings into revenue has been, my numbers have come down. But the counter to that is I think I have much more confidence in my out year numbers today than I did when I first bought the stock. And order of magnitude, like, yeah, sure, numbers have come down, but the stock, if I used to think this could be a 20x type of investment opportunity, I now think it could be like a 5 to 10x over. But by the way, we're like 2 or 3 years closer.
Yeah.
So we're 2 or 3 years closer. My confidence in those out year numbers has gone up, even though the numbers themselves have come down. But I think the decline in RevPAR we're almost through. And I think the fee revenue is starting to really accelerate into 2025 and beyond.
Let me ask you a weird question, but I talk to investors about a lot of different companies. I think there's no company I talk about more where people are, there are some shady management teams out there, but right, like IWG has Mark, who owns 25%. He's kind of the godfather of the industry. He called the WeWork collapse, which is actually how I first came to know and like him. He's been doing this for 25 years. Like the new management return machine is awesome. I don't think there's a company with like that set of characteristics that I talk to follow where people are as skeptical of the management team as they are here. And I'll just point you to a few places. Like I know you and we can talk about the capital allocation. I think the capital allocation plan, in my personal opinion, is insane. And I know a lot of other people, and I know people who say that when they say it, they use that as a hammer, right? Like if they've got an insane capital allocation plan, it's because they're seeing something you're not. And we can talk about that. The adjusted EBITDA numbers. You mentioned the partner contribution add back. I know a lot of people who get tripped up on that. I know a lot of people who get tripped up on some other stuff in the adjusted EBITDA and everything. But, if I just took it all together, like if Mark owned no stock and they were issuing shares like crazy to try to grow a la WeWork 6 years ago, I could understand the skepticism. And I do understand the skepticism, but I'm just surprised by the degree of skepticism given 25% owner, godfather of industry, called a lot of this. So again, that's a huge ball to throw at you, but I guess I'd just love to get your thoughts on all of those pieces.
Yeah, I think they've shot themselves in the foot a lot of times over the last, call it 5 to 7 years. There have been some, so there's been some self-inflicted wounds, which, that's them shooting themselves in the foot. There's been a lot of just market headwinds that they've had to overcome over the last, call it, decade, right? We've spoken about this in some of our prior podcasts. You had the dot-com bubble burst. They managed through that. You had the GFC. They managed. By the way, these are short-term leases. These are like one-year leases, shorter duration than 1 year in many instances. And so when you have a very bad economy, like occupancy could decline, vacancies go up, and they've managed through that because they have a really good business model with really good lease structures. We've spoken about this before. Their leases tend to be in SPVs, and they could hand the keys back in any of their own locations anytime they want, which gives them a lot of negotiating leverage with landlords in downturns. And there was they've gone through two big recessions since 2000. They've had Brexit, which led to a weakening of the UK office market. They had WeWork, destroying the pricing integrity of a lot of big cities because they had $20 billion of capital they were able to light on fire. You had COVID. And so all these are just examples of things that we've navigated through very successfully, I would say, because of cost discipline, because of insider alignment, and because of focus and the understanding of how to run this business. The self-inflicted stuff has been, a lot of it has been shareholder communication. I'm not going to say it's all shareholder communication. Some of it is actually fundamental performance. But the shareholder communication, they talked about getting to capital light much faster and in a manner that, probably depended too much on outside forces to convert the cap light, selling some of the owned locations to third parties to convert that into capital light. A la like Hilton selling down their hotels and retaining the management fee and franchise business. They spoke about that pretty aggressively at a time where the likelihood of succeeding in actually converting that quickly was probably not as high as you would have wanted it to be before you're talking about that to your shareholders. That's one thing. So they overpromised on the speed to getting to capital light. They started floating the U.S. relisting too early. They weren't ready to execute against the U.S. relisting, and they started floating it in Yahoo and FT articles. And then, and then they had to be like, oh, it's not going to happen as quickly as you guys think. So like they dangled that in front of shareholders. They, took leverage up to buy Instant. In my opinion, they overpaid for Instant. They bought that in 2022, but they took leverage up almost to $1 billion at a time where EBITDA was depressed coming out of COVID. So reported leverage got up to like 4 times net debt to EBITDA to buy an asset that I think was not that great. And now they're talking about they want to get to 1 times net debt to EBITDA before they start buying back stock. They're over 1, but they're less than 1.5 at this point or something like that. And so the fact that they're saying we really need to wait to get to 1 times before we buy back stock in our own business, which is better than what we bought when we took leverage up to 4 times in 2022, is a little bit hypocritical. I think they probably could start buying back stock earlier, and they're choosing not to for, credibility reasons, which I think it's actually doing the opposite with equity holders. Maybe it's giving them credibility with debt, with lenders, but definitely not with equity holders. They, had this capital markets day late in December of 23, where they put out the $1 billion medium-term target. In that, they talked about Worka, which is what they folded Instant into, growing double digits for as far as the eye can see. That was in December. Then they came out and talked about annual results in March and said, actually, Worka is not going to grow this year. So it's like, you just told us this business is going to grow double digits as far as the eye can see. You had the opportunity to tell us as far as the eye can see, except for 2024. And then you didn't tell us that at the capital markets day. You told us that when you reported full year results, which seems like you kind of like, they probably knew about that at the CMD day and not sure why they didn't disclose it. And then, Mark had this equity sale into Strength last year where he sold down 35 million shares, probably like 10 or 15% of his stock into Strength. And it's like, if you really believe the $1 billion target, why are you selling at this valuation? We spoke about that at the last podcast. But anyway, a lot of these things I think were self-inflicted communication things. I still think they're running the business very well. I think the intentions of doing the right thing to create long-term value are there. The business plan, I think, makes a lot of sense. Hopefully communication gets better from here. They have a new IR guy. They have a relatively new CFO. I understand that those things cumulatively lead to skepticism. I think the important thing to note is that the business model from here relies on them continuing to run their own locations very well, which I think they are, and then signing more management agreements And it's really nice that you're able to talk to third-party building owners and confirm the details of these management agreements and see that these building owners are happy, because you don't have to rely on management and take their word, given, to your point, historically, some of the stuff they've said to investors hasn't panned out. So I think the ability to survey building owners, talk to building owners is really important to getting comfortable with this thesis. I think once it hits the income statement, a lot of the skepticism, and by the way, once it hits the income statement and once it's reported in GAAP, which is going to be much easier to understand, and once it converts to free cash flow, and free cash flow is really growing, and they're able to buy back stock with that free cash flow, it's just going to become much more tangible to investors. And I think the fact that it becomes more tangible makes it easier for investors to value and put a multiple on.
No, it's just like you read the Q3 call and they say, hey, given the momentum in signings on the managed and franchise side, we're confident this division has years and years of growth ahead of it. And cash flow, company owned and leased, margins are expanding, our cash flow is going up. And you read all these great quotes, and then not that stock price is the end all be all, but you look at the stock price, and to, I'm sure everyone's chagrin who's involved, it's flat to down over the past couple of years. And then, as you said, you look at the Dixon sales, or you look at, hey, despite the fact that the business seems to be more valuable than ever, we need to hit 1x leverage before we will buy back shares. Or I guess we've already talked about the EBITDA numbers, so we don't need to go there. They stopped disclosing occupancy. So I know a lot of people, myself included, you start disclosing occupancy and you're like, wait, that was a pretty important KPI. And I think they had good reason for it. But you can talk to that, but
yeah, I'm not really sure it's that important of a KPI for a variety of reasons. I think it makes it easier to just think about revenue per location, because occupancy, if you're mixing the number of dedicated desks per location, right? If you have more shared space, more conference rooms,
yep.
then and if you're reducing that, occupancy could look different, right? Like, you might not want, by the way, to have signed 1-year leases in all your locations. If you can fill your space with a lot of day, users by the day, they tend to pay significantly higher rates. And so you can get much more revenue in that location if there's a lot of demand for booking by the day, or a lot of demand let's say you have more conference rooms in a given location, and those conference rooms command really high rates. You're not going to get a 1-year lease for that conference room. And so really, I think you should care about revenue per location. And then on top of that, with a lot of new locations opening up, that's going to depress occupancy. And I think investors are just going to freak out of it, right? And if you can get higher prices with slightly like 10% higher price with 50 bips lower occupancy, you should take that all day. But like, investors might freak out. And so I think there's lots of reasons why.
All of that's completely understandable. I was just saying, like, I think they disclosed it till late 2023. And anytime you've got a KPI that for years people have thought was important and management pulls it away, even if they had good reason, I know I'm not alone in being like, where did my KPI go? Like, sometimes the ball's getting hidden,
I totally agree. I think there's lots of reasons investors have been skeptical here. I think some of them are warranted and fair. Some of them are unfair. I do think Mark, his intentions are, he cares about this business. He cares about his employees. He cares about the ecosystem of building owners. He cares about the stock price, right? He still owns 25% of this thing.
Yeah.
I've spoken to people who not only work for him currently, but a lot of people who've known him or continue to know him outside of the employee-employer relationship, who say he feels slighted. He has a chip on his shoulder. He really feels like the public markets are not giving him the respect that he deserves. WeWork got a lot more respect than he ever did, even though they never make money. And, I think he has a window of, 5, maybe 10 years. I'm not sure. Does he really want to work till his mid-70s? I'm not sure, but to really get the stock price up a lot. I think he has a window here in the next 5 years to get the stock price up a lot. And if he doesn't succeed in doing that, it's hard for me to imagine he's going to allow someone else to step in and become Satya Nadella, and he's going to be perceived as Steve Ballmer. It's just hard for me to imagine he's going to hand the keys of this empire to someone else at a low starting valuation with inflecting fundamentals, who then gets to take credit for getting the stock price up 5x or something like that. And so I think either he shepherds it to a much higher stock price himself and then rides off into the sunset with a higher stock price, maybe sell some stock down before he does that. Or I think he kind of has to sell it to private equity for a big premium. And we know there's demand for these types of assets because Industrious just sold for an $800 million enterprise value for a much smaller business. And so
great transition. There have been 2 transactions over the past year. WeWork emerges from bankruptcy. and Industrious, like literally a couple weeks ago, gets bought for $800 million by CBRE, if I remember correctly. And I just want to ask, I don't know the multiple on the CBRE Industrious deal. I know very few details. WeWork, I thought it kind of came out at a crazy valuation, but I'd love to ask you what you think those deals mean, both about the industry overall and about IWG specifically, whether that's valuation, look forward, potential ownership, whatever it is. But those are two big deals in the industry, and I'd love to get your thoughts on them.
Yeah, I think, look, they set, Industrious specifically sets a really good comp, and it's a smaller, arguably faster growing concept. But I actually think with IWG accelerating its growth, now that its signings are converting into openings and the openings are filling, I think the gap in terms of growth between IWG and Industrious will narrow significantly. Industrious is kind of a more fresh, hip brand. It's, people on their MacBooks with their AirPods drinking their chai lattes versus like Regis is more me and you, sitting, chatting stocks in our Zoom call. By the way, I have a PC. I'm not sure what you're working on, but so I think Industrious is definitely like a more hip, faster growing brand. Maybe you say commands a higher multiple.
Does that matter for shared space though? Like I hear you, it sounds nice right now, but a year from now, do you want the more hip? Do you want a more hip shared space location, or do you want like a staid one where with an accountant who's going to work for 20 years?
Yeah, look, if you want more hip, we also have that too. Our space, right? We have Spaces, which is more hip and newer, and so building owners have all the above with us. I personally think I would rather the more profitable with longer operating history, more operating scale, higher margins, better free cash flow conversion company. I personally would rather that. I would, that's the one I would pay the higher multiple for. But yeah, I think it's a really good comp. Like if you throw revenue multiple or contribution, right, center level contribution multiple, you can kind of back into what you think they're making. IWG makes like 25% center level EBITDA margins. At the peak, we were at like 30. At the trough coming out of COVID, we were like, low double digits or something like that. Let's just say Industrious does 20% center level contribution or EBITDA margin. Then they're probably doing 100 million of contribution, right? And they just sold for eight times that number. If you throw 8 times on our contribution, you get multiples of our current stock price. If you throw their revenue multiple on our revenue, you get multiples of our stock price. If you throw, my understanding is that EBITDA they don't really generate that much EBITDA because they have a lot of G&A that they're going to hopefully leverage as they open more locations. But if you throw that EBITDA multiple on our EBITDA, you get significantly higher stock price. I think that's a great comp. With WeWork, it was a little bit more of, I think there were creditors who were well positioned to buy this out of bankruptcy.
Let's pause there. Why doesn't Regis own WeWork right now? Because Mark has not been shy about saying there would be enormous synergies if he bought WeWork. And I think both you and I can do the math and say, hey, I can't even remember. WeWork went for what, like 550 to one of the creditors. I think Mark's talked about hundreds of millions in synergies if he merged Regis with WeWork. Even if you value WeWork's business at a negative number, hundreds of millions of dollars synergy would more than cover that bid. So why does Regis not own WeWork right now?
Yeah, they really should. They're the natural owner. There were bondholder. There were basically WeWork is now owned by the lenders, right? The lenders took it out of bankruptcy. They put in fresh capital. But if you have the ability to credit bid your debt, you're in an advantaged position to bid for an asset. And so unless someone comes in with an over the top bid that satisfies the creditors are in an advantaged position to own it. I think Mark probably could have come up with a bid that satisfied lenders and superseded their ability to take this out of bankruptcy themselves. I don't know why he didn't do that. I think, on one hand, he has watched WeWork be overvalued by others for a very long period of time. And he's like, this isn't worth that. This isn't worth that. And he's been proven right. So I think like to sit there and think like this isn't worth that, again, doesn't strike me as crazy. I think sometimes you need to think about what it could be worth in your hands, not necessarily what it's worth to someone else if you want to win an auction. And I think it's worth significantly more to him and to us than it would be to anyone else. But maybe he figured he might get another bite at, another shot on goal. And
it's it's one of those dichotomies that I struggle with at IWG, where I'm like, Mark, godfather of the industry, owns 25%. It seems like he should know WeWork should be in his hands. And then he passes and is like, I understand maybe he thought it was worth less. Maybe he thinks he can get it for a song. But, let's say he can buy WeWork 3 years from now for $1. So he gets it for $550 million less. If there were $100 million in synergies, like over those 3 years, to miss out on all those synergies, to say nothing of the sales and getting your networks in the right place.
More than 100 million. It's 100 million.
I was being super low on cost because I think there's revenue. I think there's everything. It's like, cool, you save 550 million, but you probably missed out on $1.5 billion of value creation over those 3 years. And it's just like,
and by the way, I think having a managed offering with the WeWork brand probably accelerates the number of signings, right? When you go to building owners and say, hey, let me manage your location as a space for a Regis, I think they might say, what is a space as a Regis? But if you come to them and say, let me manage this location for you as a WeWork, a lot of them will just get it much more easily. It's an easier sale, I think. So, I think it would accelerate growth. I think there are a ton of synergies. I've spoken to them a few times about why I think it's worth paying up for. On the other hand, it takes two to do a deal. And if I don't know what their value expectations were. And if they were being unrealistic, I don't blame him, and I commend him for being patient, because I do think if they were being unrealistic, eventually they might have to become more realistic.
Yep.
I think this Anand Yardi, who controls 60% of this now, he didn't buy it. It wasn't his software company, Yardi Systems, that bought it. He personally bought it out of his family office. He's older than Mark even. I think he's in his 70s. And he's very involved in the day-to-day, is my understanding at the moment. King Street and the bondholders, they're not in the business of owning assets forever, right? They need to have exit liquidity as well. And so I think there will be a need to find liquidity here, whether they IPO WeWork, whether they sell it. If they sell it, I think Mark could have another bite at the apple. Maybe CBRE goes for it too now, because they have Industrious and they have capital. I still think WeWork with IWG makes the most sense. We could squeeze the most out of it in terms of costs and synergies and operate it the best. And, if they're asking for too much, I commend him for being patient. If he could have bought it for 750 or $1 billion and he chose not to, which I'm not sure that's possible, right? I'm not sure. Then I kind of question why he didn't do that. And, I'm still hopeful we get another bite at the apple. Maybe that's why they're not buying back stock yet. Maybe there's a shot that deal happens. I'm not that optimistic that it's happening anytime soon, right? They just took out of bankruptcy last year.
Yep.
Sometimes you need to wait for things to shake out. My understanding from talking to people in the industry is that they're still, even coming out of bankruptcy, the business is not performing that well. Even with, they pruned the bad leases. They were able to obviously restructure the business, but I still think they're really not generating cash. They're not growing the business. And if that's the case, I think there will be another shot on goal. The question, whether you get it or whether CBRE gets it, TBD, but hopefully, we're able to.
We're coming up on an hour, so I want to end it, but I've got so many questions. I've followed this company for so long, and I'm always so interested and so close to pulling the trigger on it. Let me just end with this. As you and I are talking, it is Monday, January 27th. As I mentioned earlier, the stock's trading for about 160. I can never remember if it's pound or sterlings, but whatever. You said, hey, if they hit the targets over the next 5 to 7 years, you could see a 5 to 10x. Can you just help walk me through the math of how you kind of get to that valuation? And it can be as easy as starting with, they said the medium term, $1 billion adjusted EBITDA numbers here, so I get to free cash flow. But I'd love for our listeners just to be able to do the math of how you kind of get to such large upside.
Yeah, I think $1 billion of EBITDA. I'm actually slightly over $1 billion. I'm closer to 1.1 by 2028.
And you've adjusted for the partner contribution. We don't have to spend crazy amounts of time on it.
Yeah. So $1.078 billion is where I am for 2028 EBITDA in dollars. By that point, partner contributions aren't 100 anymore. They're called 75 million or something like that. So $1.078 billion gets down to $1 billion after partner contributions, because the leased portfolio is getting smaller and smaller as a percentage of overall EBITDA and in nominal terms. And taxes, 200 million or something like that. So like you're in the mid to high 750 million of free cash flow or something like that. There's no debt anymore in the business. In fact, at that point, you're sitting in a net cash position. And so in theory, the share count could be lower even, right? Like I think you probably have $1 billion of net cash at that point. And so $1 billion of net cash plus name your multiple on $750 million of free cash flow, of which a significant portion is coming from management fees. I don't know, 15 times doesn't sound crazy to me. That gets you to 11,250 plus, $1 billion and change of net cash on the balance sheet. That gets you to like a 12-pound stock compared to 170 today.
Perfect. And you get, as we discussed, they just converted to they're converting to US GAAP. I can't remember if it's completely done or if it's this year it's done. They're already reporting in dollars. Like you and I have talked offline about the relisting opportunity. Nobody likes to own UK stocks, but everybody likes to own US stocks. And if this relists, this could get interesting pretty quickly.
Yeah. By the way, like there's a shot they end up generating much more cash. There's a shot EBITDA ends up being higher. But the real thing is the multiple really could be higher than 15 times at that point, right? Like it's not crazy to think this trades at 20 times, right? 20 times 750 is 15 billion plus cash.
As you said, they start putting a multiple on that managed service businesses, it could get crazy. Or there's a chance they buy WeWork 2 years from now, and all of a sudden
they could buy WeWork, could add scale, could add synergies, add profitability. Down the line, let's say they do buy WeWork, or let's say they buy a bunch of other small, struggling operators and get more scale. Once you get more scale on both sides of the business, the managed side of the business and the owned and operated side of the business, you could split them up, a la Hilton, which I spoke about earlier. I think you probably need hundreds of millions of EBITDA on both segments so that they could each stand alone on their own. Yeah. But you could eventually sell, the owned business for 6 times EBITDA, 5 times EBITDA, 7, depending on what you think the managed side of the business will trade for, and buy back stock on the managed side of the business, or pay yourself a special dividend, and then you're holding on to. So that there's lots of things you could do over time to create value. And if public markets don't give you that value, I think there's private equity interests that could extract that value for themselves, whether it's Brookfield or Blackstone or right. There's lots of private equity firms that see what value is here and probably are pretty sophisticated in terms of thinking about how to extract that value for themselves. So, all
right, actual last question.
Yep.
We've talked about IWG multiple times on and offline on the podcast over the past 2 years. At some point the valuation gets low enough and the momentum gets big enough that the market's not going to be able to ignore it anymore. And I suspect that's 2025. If you and I were talking here 18 months from now and forget the stock networking, but the momentum here had stalled out for some reason or another, managed signings down, the business isn't working. What do you suspect the most likely reason other than, hey, we're in a massive recession would be?
Yeah, it's a recession, or you've bitten off more than you could chew in terms of you're opening too many managed locations too quickly. You're not filling them. You're not focused on providing a good experience for your building owner partners. And that destroys the integrity of your product offering and your reputation. And then you stop signing new locations, and the market doesn't put a multiple on the management fee because they think it's not a durable, enterprise. And they think it's going to be a melting ice cube.
This podcast is sponsored by Daloopa. Earnings season is hectic. There's no way around it. But what if you could take back the time you spend on manual model updates? With Daloopa, you can. Daloopa automates your audit and update process, instantly pulling accurate, fundamental data from filings and reports directly into your models. That means no more wasting hours on repetitive tasks. Instead, you can focus on analyzing trends, refining strategies, and staying ahead of the competition. Stop letting manual work slow you down. Set up a free account today by visiting daloopa.com/YAV and see how Daloopa can transform your workflow. That's Daloopa, DALOOPA.com/YAV.
This has been great. Yaron Naymark. Hopefully next podcast, we're going to have to do a different name than IWG. But look, this is one of the most fascinating stocks. I continue to follow it really closely. I've been long in the past. I wouldn't be surprised if I'm long in the future. I have friends who are long and it's just a fascinating story. But, as there, just one or two things that it's a little funky, but it's hard. I'm with you. It's just hard to see hey, you've got the base business, you've got the management business ramping up. It's hard to see material downside, and the upside if the management business keeps ramping is just enormous.
Yeah. I think, there aren't many. The reason why it's my biggest position is because I think you could do well, even if I'm wrong on the managed side of the business, just based on the current valuation. You could do fine. If we go into a recession, maybe you lose a little bit of money, but I don't think you get diluted into oblivion here. I don't think you get permanently impaired. We're generating cash. We're at a cheap starting valuation. And I really think there's an open-ended S-curve-like growth story here, which I don't really have in my portfolio most of the times because I'm a value-oriented guy. And so
because we're buying cash shells that find litigation-related ways to blow 10% of their market cap out of nowhere constantly.
Exactly. Like open-ended growth stories don't normally come attached to a business that's trading at 7 times free cash flow. And that's kind of how I view this. So
I love how you comped it to KKR because I was there for KKR, not as long as you, unfortunately, but it does remind me that we're with KKR, it was like, hey, I remember the stock's at 20 and they have $12 per share of balance sheet investment. So it's like you're buying this management business.
When the stock's cheap, there's always a reason. With KKR, to your point, there was a reason. Oh, it's levered beta, we're at peak alts. In a downturn, the balance sheet's going to get smoked and their portfolio companies are going to get smoked because everything is leveraged. They're never going to be able to raise bigger funds again. They're already so big. Like there are lots of reasons, but like the reality is that we're strong secular tailwinds with a really good business at a low valuation. And I think that's kind of what we have here. I will caveat that by saying like, I'm always looking for signs that I'm wrong and I'm open to changing my mind. And I have changed my mind in the past. So I continue to follow this business very closely because it's a big position and I might change my mind tomorrow and sell my position. But, based on everything I know to date, which I've been doing 2.5 years of meaningful research on this name at this point, based on everything I know to date, I think I'm right. And I think it resembles KKR to me. And I hope it works out that way.
If you did a survey tomorrow of 50 billion owners and the responses went from mainly 4s and 5s to mainly 2s and 3s, would that change your mind?
It would definitely make me question what was going on. And, I would try to have conversations with those building owners and see if I could understand what was driving that displeasure. But it would definitely be a sign that something's going wrong for sure.
It's just, I look at a lot of these franchisees businesses, how the franchisees are responding is always it's always a difficult one for me to base because I will find that sometimes the franchisees are just furious because they want to be making more money and that's the bottom line. And sure, everybody does, but they're like making really good money and they just want to be making more money. But then sometimes it's like, hey, they're revolting because there's real issues with the business. And it's always tough to like in the multivariate complexity of, franchise happy, sad, whatever, like weigh that against stock price really down, managed business is completely free here, all that type of stuff.
Yeah, so most of the building owners that have these management contracts have multiple buildings. And so one of the questions I ask in the survey is how likely are you to give another one of your buildings to IWG in the next 12 months with a management agreement? And so like, if they all went from 4s and 5s to like 2s and 3s, but they were still answering 4 or 5 on likelihood to give IWG another location, then, that would be one thing. But if they all went to like 2 and 3 on both of those questions, I think that would be kind of scary for me.
It reminds me of that French trader who, instead of asking people, are you going to vote for Donald Trump or Kamala Harris, it said, who do you think your neighbor is going to vote for? And was like, oh, everybody thinks their neighbor will vote for Donald Trump. Let's load the vote. Like, if all the franchises are like, this sucks, I hate it. Oh, yeah, we'd love to open as many as humanly possible under the IWG. It's like, well, your actions are kind of speaking louder than your words. Yaron, we've gone way over. This has been awesome. Appreciate you coming on. Looking forward to, I think it's going to be time number 7 when you come back on. We're approaching a 10% concentration in Yaron Naymark podcast, but it's been great. We'll chat soon, buddy.
Cheers. Thanks.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.